Very good morning, friends. So lovely Sunday morning, and we are about to close the inputs on consolidation with you. So, we carried out the trail of a couple of standards in the previous sessions. We covered business combination, Index 103, and we are on Index 110. Well, last time we had a discussion, an input introduction in terms of consolidated profit and loss. So today the focus is to do the consolidated P&L. I've already given you a mind map in terms of how the consolidated P&L is done. Then the focus today is on associate as well as in terms of joint ventures. I'm also planning to make some good mind maps in terms of adjustments related to the consolidated balance sheet and P&L for a subsidiary as well as for an associate. And maybe, the time permits, hopefully, yes, where I would like to take a question on a balance sheet which contains a subsidiary as well as an associate and a consolidated P&L which contains a subsidiary and an associate. A lot more to come in the powerful packed session. So I think let's begin with the journey. So I'm going to start the inputs in terms of making a consolidated P&L. Just to revive the concepts in terms of the 5 adjustments which we talked in terms of P&L. If there is an intercompany owing, it stands ignored because that's a balance sheet aspect. In terms of the stock reserve, we need to be careful because we'll eliminate the common sale and purchase from the sale and the cost of sale, but remember to add a stock reserve to the cost of sale. The third input is the fair value adjustments, which would only lead to increased depreciation or maybe a reversal of an excess depreciation. The goodwill impairment would also lead to an increased expense. And number 5, if there has been any omissions, you need to consider, let's say, for example, a DC omission, you will end up taking a finance charge in the P&L. But I think the only caution which you need to take care is once you get the profits, you need to divide that profits between the parent and the NCI. Now, the only caution is that when you calculate the profits attributable to the NCI, you need to get the focus clear. The reported profits needs to be converted in terms of rectified profits. And there are 3 focus points in terms of converting the reported earnings into a rectified earnings. If there is a stock reserve, which is upstream in nature, goodwill impairment, if the NCI is taken at a fair value, and you need to consider the additional depreciation as well. Once those 3 reductions are done, the reported profits of the subsidiary gets converted into a rectified profits, and then the NCI gets a share on that profits. So let's do a little practical illustration, consolidating these concepts on a consolidated P&L with you. So I'm just going to share a small question with you, not a very technical one, but I think a good one indeed. So let me just, share the inputs. Right, so this is the question we are looking at. It says, given below is the statement of P&L for Paris and its subsidiary London for December X9. So this is the profit and loss which is given, but we have some additional information to be watched out. So maybe you can take a snapshot of the question as we proceed. So in the additional information I am given, it says Paris paid 1.5 million on December X1 for 80% of the London share. Now, I also gave you last time that, the first focus should always be to see what is the date of acquisition. Because if the date of acquisition is before the current year, the entire current year becomes post-acquisition in nature. And if the acquisition date is in between the current year, then it's partly pre and partly post. But we need to consolidate only the post-acquisition period. So in this case, we are safe because the acquisition was way back in X1 and the consolidated P&L we are preparing on December X5. Then he says goodwill impairments are given and a further impairment is found to be necessary at the year end, and the impairments are taken in the administrative expense. But we'll also need to consider whether the goodwill impairment, the goodwill is full or partial in nature. accordingly we'll deal with that. So maybe later he tells you about the NCI, though you can see in point number 6 in advance that the Paris company is calculating NCI at a fair value, which indicates the goodwill is full. Then he says Paris made sales to London. That means it is downstream in nature at a selling price of 6 lakhs during the year. Not all the goods have been sold externally by the year end. The profit element included in the closing inventory is given. So we're already given that what is the stock reserve, the unrealized profit, and it's a downstream transaction. Then we're also given the additional fair value depreciation for the current year is 10,000, and all the depreciation is taken as a part of the cost of sales. Then he says London paid a dividends during the year. So when the subsidiary will pay a dividend, the parent will get a dividend as well, since he's got an 80% stake in the company. So 80% dividends will be received by the parent. So that would also be need to be eliminated, because this is something which is not a income from the group point of view. Point number 6, we have already read NCI at fair value. We need to make a consolidated P&L for the year ended December X5. Now, I think if you look at the focus points, we're given in point 2 the goodwill impairment. So that would, of course, hit my NCI calculations for the rectified profits. Then in point number 3, you are given the stock reserve, but that's downstream. So that will not impact the calculations in terms of NCI share in profits. And there is an additional depreciation, which will, of course, be taken in the calculation of the rectified profit of NCI. So nothing much. I think we've got 2-3 adjustments: stock reserve, depreciations, impairment. I think that makes a good one, because there is no intercompany owings, and as it is, it's got no impact. So more or less, we've got, almost all kind of adjustments in this case. Now, in this particular case, I think you can also take a little snapshot of the income statement as well, because now we just do the consolidated P&L considering the information. So I'm just going to stop sharing the screen and let's begin with the inputs. So I am looking at the concept of making a consolidated profit and loss statement. So we'll make a set format. I think the columns are important. So what we're going to do, we're just going to create some basic columns, which we should always do. Take a column for particulars, one column for the parent, one column for the subsidiary, one column for making the adjustments, and the other one is a total. So I think that is how the consolidation will be done. So we take a column particulars. This is the parent company. This is the subsidiary. Then we consider adjustments, and then we consider total. So in this case, we'll keep consolidating the position. As you know, that just like assets and liability, income and expense are also aggregated, but we just need to take care of the adjustments. So I'll just keep picking up the information. And in this particular case, we are given revenues to begin with. So as far as revenue is concerned, I am given the revenue for the parent company is 3,200. All these figures are in thousands. And the subsidiary is 2,560. Now, the only thing which we need to take care is the additional information, wherein I'm just reading what is given in terms of the point number 3. Paris made sales to London at a selling price of 6 lakh. In terms of 1,000, it is 600. So there is a need to eliminate the sales between each other. Now, one thing which we should always be cautious on, and that is that when you're considering the elimination of the intercompany sale purchase, even if the goods have been unsold or they are completely sold, it doesn't make a difference. Elimination of this will always get done. So let's consider the sum total. So add the figures, reduce 600, it is 5,160. So the best thing is that you just need to pick up the information from the P&L format as it is. The next is I am given the cost of sales, and for the parent company it's 2,200. For the subsidiary, it is 1480, and you need to reduce that 600, which is the intercompany sales between each other. And apart from this, I am also given very clearly, back to the point number 3, the profit element in the unsold goods is 30. So what we need to do, we need to add the stock reserve to the cost of sale. So this works out at 2200 plus 1480 minus 600 and plus 30. So that works out at 3110. So I think with this inputs, we get the element of gross profit. Though, of course, it's a little international question. We do not show any GP under the Indian context, but I am just going with the format which is given in the question. So we get the GP. So I'm just taking the column, that's the total one. So from the revenue, we reduce the cost of sales. It works out at 2050. As simple as that. But I think there is one more information pertaining to the cost of sales before we miss out. And I'm given in the point number 4 that additional depreciation is supposed to be 10,000, and that is also a part of the cost of sale. So due to the fair value adjustments, there has been some additional depreciation. So I think we should add that depreciation out here as well. So we have to slightly change this to 3120. And we get this as 2040. So as we keep considering the consolidations of the revenues and the expense, we just need to keep a track in terms of all those adjustments which are given in the addition information. Next, I am given there is a distribution cost. So we consider the next expense, the distribution cost. So the distribution cost is 160 and 120. There is no addition information. So that makes it a total of 280. Then there is an administrative expense. And administrative expense, I am given it's 400 as well as 80. And we just make a scrutiny for any expense relating to administration. And I guess for the administration, we're given in the point number 2. It says goodwill impairments at the beginning of the year is given. That's not my concern. But it says there is a further impairment at the year end, and the impairment is a part of the administrative expense. So the impairment 40 is going to be taken in the adjustments. So this makes it a total of 520. So I guess now if you see, the point number 2 stands done, the point number 3 stands done, the point number 4 stands done. The only information which is pending is the dividends which is paid, that we can just shortly take care. But this is going to give us the operating profit. So once we get the adjustments, this is the operating profits. And trust me, I think the consolidated PL becomes even far easier as compared to the balance sheet, because I think the adjustments don't become very heavy. So this is 1240. That is supposed to be the operating profits of the company. We continue with the information. The next item which is given is the investment income. So let's first continue with the formatting. So columns for the particular, one for the parent, subsidiary, adjustments, and the total. So parent, subsidiary, adjustments, and the total. So let me just take the operating profit 1240 as a base. So that becomes the operating profits of the company. Next, we are given the investment income. Next in the profit and loss is the investment income. And once you consider the investment income, we need to be certain if the parent receives any dividend from the subsidiary, it's not an income from the group perspective. So that needs to be eliminated. So if I pick up the information, the investment income is given the 160. But I guess if I go back to the additional information, I am clearly stated the parent has got 80% shares. The subsidiary paid a dividends of 2 lakhs, which is 200. 80% of this, that is 160, will be received by the parent. So out of the total dividends of 200, which is paid by the subsidiary, the parent gets 80%, that's 160. And that is not an income from the group point of view, that gets eliminated. Wonderful. So I think that is done. Investment income is done. This is going to give us the PBIT. So this gives me the information, which is PBIT. So that remains at 1240. And moving further, I am not given any interest expense. So this is as good as my PBT. And then we consider taxes. And the taxes is given 400 as well as 480. No adjustments defined. So this is 880. So we will get the profit after tax. I think I'll just like to show the question once again to you on the screen, just to get the dots connected well. So as we can see that we've taken the informations in the P&L, all the inputs in the P&L is done. And I think we just make a scrutiny in terms of the additional information. Point number 1 is only telling you the acquisition date and the percentage. So point number 2, goodwill impairment is taken. Point number 3, the stock reserve and the intercompany sale purchase taken. Point number 4, the additional depreciation taken. Point number 5, the interim dividends taken. And the point number 6 is only telling us NCI as a fair value. That's it. So now we need to get the profits and split this between the parent and the NCI. Now, when you take the NCI, we will get the rectified profits, but that's later. Let's first get the profits based on this. So 1240 minus 880, that works out at 360. So this is supposed to be the profits after tax. Now this is to be divided. So the profits are attributable. The profits are supposed to be attributable to the parent company as well as to the NCI. Now, the only caution which we need to take care is that when you split the profits belonging to the parent and NCI, you need to first of all compute NCI and the balance goes to the parent. So we need to get the rectified profits in this case. So let's make a small working note. This is regarding the computation of rectified profits of the subsidiary company. So for the purpose of calculating the NCI share in the profits of the subsidiary, we need a rectified profits. So let's take the reported profit as a base. And we know that we need to make a total of 3 adjustments. Number 1, we need to take care of stock reserve if it is upstream in nature. Number 2, we need to consider the additional depreciation due to the fair value adjustments. And number 3, we need to consider the goodwill impairment if the NCI is supposed to be at a fair value. So I think these are the 3 adjustments. Once you get the focus points, it's simple. Now, if you go back to the question and if you see what is the reported profits of the subsidiary, the reported profits of the subsidiary is 400. And I think if you make a scrutiny of the additional information, so I am given the information regarding the impairment, it is 40. So goodwill impairment is 40. Stock reserve, it's downstream and not upstream. And additional depreciation is supposed to be 10. So I think that's it. All the information stands taken care. So this will give us the rectified profits. So this gives me the rectified profits of the subsidiary in which the NCI will get a share. So this is 350. So once we get this, we go back and we can calculate the NCI share. Out of this 350, 20% belongs to the NCI, that is 70. So 360 minus 70, the balancing figure 290 belongs to the parent company. Wonderful. So that was simple and that was strict. So, the consolidated P&L you can see becomes even far more easier in terms of doing things. And if compared to the balance sheet, you've got rigorously all those 7 steps, but P&L becomes a job easy. So this was on Index 110, looking at a consolidated balance sheet and looking at, you can say, the concept of a consolidated P&L. Now, if you recall in our discussions on consolidated financials, I said, you can divide your entire discussions into 3 elements. One is the control assessment, which we did, last to last session. There is a consolidation procedures in terms of balance sheet and P&L, which we have seen now. And then there is a block number 3, which talks of changes in the ownership interest. So I think this is one thing, but I want to make a mind map at the very start. So let me, add a mind map number 1 for the day. So I'm looking at now the next agenda, where I want to first make a mind map. That's the mind map for the day. This is changes in ownership interest. This is changes in the ownership interest. So we're looking at the changes in the ownership interest. Now, when we say that there is a changes in the ownership interest, your mind should start working that this could be a step acquisition or this could be a disposal. So I would say basically, when you look at the concept of changes in ownership interest, I would say typically the situation could be either it is further acquisition or it is a disposal. Once it is a further acquisition, it could be a conversion from an associate or a passive to control, or it could be a control to control. And when you look at a situation when it is supposed to be a disposal, either it remains under control or it's a conversion into an associate, or in terms of a passive investment, or maybe a complete disposal. So let's make a solid chart on this. So we can segregate this inputs in terms of 2 parts. One is we can say that there is a further acquisition. This is what we can say is a step acquisition. This is what we can say is a step acquisition, or we can say it is supposed to be a case of a disposal. Now, when you look at the case of a disposal, I would say the situations is either it is a full disposal, or I would say it becomes a case of a partial disposal. Now, first of all, let's consider that if it is a case of a full disposal, before that, I guess let's also segregate the partial disposal. In terms of partial disposal, it could be that the control continues. The control continues, or we can say it converts to associate. It converts into an associate company. Or we can say it becomes a passive investor. Or it becomes what we can say is a passive investor. So I just was trying to visualize the situations which can happen. That if it is a disposal, either it's a full disposal or it's a partial disposal, where the control continues, or you convert into associate, or it becomes a passive investment in this case. And when you say that there is a further acquisition, then we can say there are 2 permutations, combinations in this. So either we can say that the control continues. You also had a control earlier, and still the control continues, or we can say it could be 2 cases: conversion from a passive investor to a case of control, or it could be a case of conversion from a significant influence to a case of control. So your mind should start working into all these different permutations and combinations. Because when you look at further acquisitions, it's either a conversion from a significant influence to control, a passive investor to control, or maybe the control continues. And if it is disposal, either it is full or it's a conversions into different combinations. Now, let's, I think, first mind the map. If you look at the situation number this one, I think if you look at this particular situation, passive to control or significant influence to control, you would easily recall that this is what we have covered in Index 103. This was covered in Index 103 when we were discussing the concept of a business combination. Just to connect the dots once again. So we decided once it is a conversion of a passive to a case of control, the book value of the investment compared to the fair value, and depending whether you were accounting it under FPTPL or FPTOCI, you take the gain or loss in PNL or OCI. If it is a case of a significant influence to associate, in that particular case, you need to consider the book value as per the equity method compared to the fair value, and the difference enters the P&L. But this is one case where I also gave you that a scrutiny of the OCI is required. Because during the application of the equity method, you would have accumulated some balance in the accumulated OCI, and that needs to be filtered in terms of R and NR. So I think that discussion we did in terms of step acquisition, PHI, that was 103. So we're not coming to that. Now, if you say the control continues, let's put it like this, that this becomes a case number one. And here also, if you say it control continues, this is one. Now, in this particular case, if the control continues, then I think there is no problem. Because in this particular case, we are not putting an entry because the control does not come to an end. Neither we're getting a control, nor the control is going off, it continues. So that's no. I think the focus is on this one. It is a full disposal, or we can say it converts into an associate, or we can say it converts into a case of, you can say, the passive investor. So we're going to consider the cases control continues as one set of entries. And there is a full disposal, or a conversion to associate, or a conversion to passive investor. So we're going to see two entries in this case. So let's consolidate the inputs. So breaking all these permutations, combinations effectively into two cases. Breaking this effectively into two cases. So I'm looking at the point number one. The control continues in further acquisition. The control continues in a disposal. So we're looking at the first one, that is control continues. Now, when you say the control continues, in this case, we've already seen that there are two cases. Either it is step acquisition, or it is supposed to be a disposal. So two cases are there in this case. Either it is a step acquisition, or it is a case of disposal. Now, when it is a step acquisition or it is a disposal and the control continues, is just a change in the NCI. That's it. So in this particular case, when it is a step acquisition, the NCI needs to be reduced. So NCI gets a debit and the bank gets a credit. And any balancing figure in this entry is taken to equity, directly to SOKI. Because we are supposed to reduce the NCI at a value, and then whatever payment is made to acquire the further stake gets a credit. Any difference is adjusted in equity, because this is a transaction between the shareholders. It's got no impact on the PL. And if you say it is a case of a disposal, then the reverse entry, bank gets a debit with the sale proceeds, NCI increases, and any balancing figure in this entry is taken to equity. So this is one case situation, that is when the control continues. Either it is step acquisition or it is disposal, but the control continues. So only changes in terms of NCI. Then comes the next focus point. The second focus point when I've given you, either it is a full disposal or conversions to associate and investor. So we can say the control is gone. So when you say the control is gone, so there are three typical situations in this case. Either we can say it is a full disposal, or we can say it is a conversion, or we can say it is a conversion to associate, or we can say it is a conversion to passive investment. It is a conversion to a passive investor. Now remember, in all these three cases, the net entry always remains the same. I always treat this, if you remember, in the regular sessions also we made a discussion that in these cases, we comfortably go with the position that you're switching out of Index 103. So whatever entry was done at the time of acquisition, a reversal entry of 103 needs to be done. So effectively, in this particular case, we can say we need to basically go for a reversal of acquisition entry which was done under Index 103. So in this particular case, I think just to focus on that reversal entry in the minds. So what do we need to do? The bank gets a debit with the sale proceeds. If there is any investment which stands retained, that will be captured at a fair value. The bank is debited with the sale proceeds in this case. And then we need to derecognize those goodwill, NCI, and the net assets. So we can say the NCI gets a debit, the net asset gets a credit, the goodwill gets a credit. So this is like the derecognition. This is the derecognition of all those things done on the acquisition date. So the bank gets a debit with the sale proceeds, the investment retained at a fair value, derecognitions of the net assets, NCI, and the goodwill. And there's a balancing figure in this particular entry. The balancing figure is the gain or loss which is taken in the profit or loss. So I think that gives us a good consolidated mind map. So your focus needs to be very clear. Which situation do you fall into? Is it a case of a control continuation changes in NCI? And it is a case of a control either completely gone or conversion into some other status. It's a reversal entry in terms of Index 103. The acquisition entry is practically being reversed at this particular stage. I think that's simple and straight indeed. Okay, so one other thing, which you need to keep into mind is once it is supposed to be, a case of a subsidiary becoming an associate, then I think we need to take care of some elements of OCI as well. Okay, so that was quick inputs on this area. Now, I think we have a wonderful question which is there, I guess, on this particular part. No, that's on the associate. I think I'll talk of that in terms of associate. When I come to the inputs in terms of Index 28, I think we'll talk of that particular question at that stage. Okay, so far so good. So Index 110 gets consolidated in my mind in terms of three blocks: the control assessment, the consolidation of the balance sheet and the income statement, and the changes in the ownership interest the mind maps made. Now, I think let's focus in terms of associate, and we would like to come back again to the balance sheet and the P&L from the associate perspective. Because what I feel that there can be two kinds of questions on the associate accounting. One is you get an independent question just on the associate. And the other one is that you get a question which is on a balance sheet, subsidy with an associate, or you get a consolidated P&L, subsidy with an associate, where all those five adjustments which we did in terms of the subsidy becomes applicable for an associate as well, where we're going to draw a wonderful mind map. But I think first let's begin with the inputs, and let's, I think, make some mind maps on Index 28 associate. So I am making my second mind map for the day. So mind map number 2, which is technically on Index 28. that is accounting for associate and joint ventures, accounting in terms of associate as well as joint venture. Now, as I said, once you're looking at an accounting of Ind AS 28, there can be an independent question which is asked in terms of Ind AS 28. And for this purpose, you would remember that, when we did the regular sessions, I segregated the entire accounting under equity method in a two-step model. So when you're looking at the accounting under Ind AS 28, we've got what is called an equity method of accounting. So in terms of equity method of accounting, we're going to apply a simple two-step model. So we're going to apply in this particular simply a case of a two-step model. So let's make a chart indicating the two steps which we will apply in this particular case. I would say the step number one is identifying the goodwill or the capital reserve, which of course is not reflected in the outer column in the consolidated balance sheet, but is presented as a part of the carrying value of the investment. The goodwill or capital reserve only becomes a subject matter of disclosure in the inner column of the investment. So your focus in terms of the step number one. The focus in terms of step number one is to identify the goodwill or the capital reserve. So once you identify the goodwill or capital reserve in terms of step one, you need to compare the purchase consideration, that is investment, that is to be compared with the share in net assets. That is to be compared with the share in the net assets. So the calculations are quite similar to the consolidation, except that in terms of the consolidation, you take PC plus NCI and compare it with the total net assets. But in this case, we need to compare the PC versus the share in the net assets. And once you get the goodwill and the capital reserve, so this goodwill or capital reserve is a part of investment value. It is a part of the investment account. It is disclosed. It is disclosed in the inner column, but does not appear as a separate line item. Oh, that becomes technical, I guess. So let me just, I think, reiterate that. So once you compare the goodwill, once you compare the investment and the share in the net assets, you get the goodwill or the capital reserve. And this goodwill capital reserve, unlike Ind AS 110, does not appear as a separate line item in the balance sheet. It's only disclosed as a part of the carrying value of the investment. It's just a mere disclosure. This is step number one. Then comes the input in terms of the step number two. In terms of step number two, what you need to do, you need to consider the post-acquisition changes. In terms of the step number two, you just need to do the post-acquisition changes. Now, in terms of the post-acquisition changes, I always tell that there are two aspects what you need to consider in step number two. One is you need to consider, you can say you need to keep a track of the changes in the net assets of the associate. Because as the net assets of the associate changes, the value of the investment also undergoes a change. So I always tell you that, you need to consider the changes in the net assets of the associate, track them. So if the net asset goes up, the investment goes up. With the share, the net asset goes down, the investment goes down. And the second aspect is what is called a mirror accounting. Though it's not technically called that, but we understand that it's a mirror accounting, that once you know that the associate gave a credit to the P&L, the investor also gives a credit to the P&L. So if he gives a credit to OCI, you also give a credit to the OCI. So in terms of the step number two, there are two things to be done. One is you need to track the changes in net assets. That's how you can map your mind. So one is that you need to track the changes in the net assets. So once you say that you track the changes in the net assets, tracking the changes in the net assets would mean that if the net asset goes up, so does the investment value goes up, and vice versa, and vice versa. So that is tracking the changes in the net assets. The net assets moves up, the investment goes up, but the share in the increase. And the second input what comes is what I call as a mirror account. The second is what we call the mirror accounting. Now, when I say it is supposed to be a mirror accounting, in this particular case, if the associate credits the profit and loss or the OCI, or you can say equity, the investor also credits the same components itself. I think once you're able to apply this equity method of consolidation, it's pretty simple indeed. Step one is all about goodwill capital reserve, and step number two is the post-acquisition changes. You just need to capture the change in the net assets to capture the investment debit credit and a mirror accounting. Whatever is the credits or debits by the investee associate, the same debits or credits is done by the investor as well. That's a question on a standalone basis. Let's see one question on this area, which is a past examination question. So let me take you to one question on this particular area. Let me share the inputs. So January 21, 5-marker examination question. We'll do 18 and we'll do 19. 19th is also a pretty interesting one. Now, in terms of the question number 18, I am given, it says on 1st April 2019, BIG acquired 35% interest in DIG, and it achieved a significant influence. The cost of the investment is 3 lakhs, and DIG has got net assets 5 lakh 50 on 1st April 2019. And the fair value of those net assets is 650, since the fair value of PPE is 1 lakh more than the book value. Naturally, when you go to calculate a goodwill, you got to compare the investment versus the share in the net assets at a fair value. So the increase in the book value and the fair value is attributable to the fair value change in the PPE. This PPE has got a remaining life of 8 years, and then it says for the financial year 1920, the company earned a profits of 1 lakh and it paid a dividend of 11,000 out of these profits. They has also recognized a loss of 15,000, which is due to remeasurement of defined benefits directly in OCI. Calculate the BIG interest in DIG at the end of the year March 2020 under the relevant method. So I think what we need to do, apply a two-step model in this particular case. So let's begin. So question number 18, examination question. So I think it is good that we start with the two steps in this case. So we begin with the equity method, the two-step criteria to get the inputs. So I'll split my answer for ease of understanding. In terms of this, don't do this in the exams in terms of charts. You should be giving proper answer, but this is just, give you a flair of the inputs, a bird's eye view. So I'm considering the step number 1, which is being done on the date of acquisition. And I'm looking at the step number 2, which is the post-acquisition changes. Which is the post-acquisition changes in this case. So I think if I just, look at the data, so we are given the cost of the investment is 3 lakhs. So we can say the investment is purchased at 3 lakh. We compare this with the share in net assets at a fair value. That's important. Then we need to consider the share in the net assets at a fair value for this purpose. So I guess if I just consider this, so we are given the fair value of the net assets is 6 lakh 50, and we've got a 35% stake in this company. So if I take 650 into 35%, that's 227,500. So we can get the difference that is supposed to be goodwill, and that of course will be disclosed as a part of the inner column 72,500, that becomes the goodwill. Now this particular goodwill is going to be reflected as a part of the carrying value. So if I were to make a consolidation on this date, it remains 3 lakhs with a disclosure of goodwill 72,500. Now let's consider the step number 2, that is post acquisition changes. The base would remain the same. So when you consider this, the base will remain the same, whatever is the cost of acquisition. Now we just need to track the things which I said earlier. You just need to see the changes in the net assets of the associate, and correspondingly the investment gets a debit or a credit. Now, one thing which is very clearly given in the question is the value of the property, the fair value was greater compared to the book value. Now we need to appreciate one thing. The reported profits of the associate company is without considering the fair value change in PPE. So he would have taken a depreciation based on the book value. So when you consider the profits, you need to consider the additional depreciation. The associate earned a profits, the net asset goes up, so would the investment. So we add the share. I'm putting it as share in rectified profits. I'm putting it as share in the rectified profits of the associate. In 1920, they earned a profit of 1 lakh rupees. From this, we need to reduce the additional depreciation. So we know that 1 lakh is the value of the asset, book value, and the fair value difference is 1 lakh. This 1 lakh is got a life of 8 years. So you reduce the additional depreciation. So we take a 35% on this. So 1 lakh divided by 8 additional depreciation. So we take a 35%, that's 30625. So this is one element done. Now, if the associate company pays dividends, the assets will go down. So share is 35%, that works out at 3850. So that is tracking the changes in the net assets. They earned the profit, the net assets went up, investment goes up. The dividend is paid, the net asset goes down, the investment goes down. And but from this, we are also given that there is a remeasurement loss which is taken in the OCI. So when the asset took a remeasurement loss, the net asset went down, so would the investment. So minus the share of loss in OCI, so that is 15,000, and we've got a 35% stake in this. So 15,000 into 35%, that's 5250. Right, I think that's it. Nothing else is further defined. So we can take the value of the investment. That was pretty simple and straight, 5 marker in the exam. So 3 lakhs is the base, plus 30625, minus 3850, and minus 5250. This works out at 321,525. So that works out at 321,525. This is the value of the investment in the balance sheet. So in the console, you're going to show this figure with the disclosure of the investment in the inner column. Just to give you a little clarity further, this amount enters the creditor P&L, this is the debtor P&L, and this is the debit of OCI, mirror accounting. So whatever is credited or debited by the investee, associate company, the same debits or credits is done by the investor as well. So this was on Index 28. If you get a standalone question on the application of equity method of accounting. Let's do one more question, interesting one, which is also come in the exams as well, where there is a concept of equity touch. I think let's have a look. Let me go to the next question with you. That is question number 19. Now, let's, I think, first read the inputs, some very interesting facts given in the case. It says entity A has got a 20% equity interest in B, an associate. That that in turn has got a 100% equity interest in C. Now the chain is interesting. A's got a 20% stake in B, and B has got a 100% stake in C. So B is an associate of A, but C is a subsidiary of B. There is a chain, but the chain is interesting. Now it says entity B recognized the net assets of C in its consolidated financials. Entity B sold 20% interest in C to a third party, a non-controlling shareholder, for 300, and recognizes this transaction as an equity transaction in accordance with the para number 23 of Ind AS 110. Now you can well imagine B has got a 100% stake in C. And when he sold 20% interest in C, it is a case where the control continues. It is a case which we just saw that there is a disposal, but the disposal still means that the control continues in this case. So which means he would have done the entry, bank gets a debit, NCI gets a credit, and the difference must have been taken in terms of equity. So I think if I just like to connect the figures, since you sold the 20% interest at 300, the entry which would have been done would have been bank account debit, and the NCI gets a credit, and we get the difference, that is 100 in terms of equity. Okay, so I think before we proceed further, let me just give you a quick connect of the information as well, so we understand that better. So in terms of question number 19, so we can see the status. There is a company A, there is a company B, and there is a company C. So if we just try to gather the information, so we can see that A has got a 20% stake in B, and B has got a 100% stake in C. That's the chain. So B is supposed to be an associate of A, and C is a subsidiary of B. Now, in this case, there has been a 20% disposal. So once there is a 20% disposal, we can say 80% is left over, but we can say the control continues in this case. The control continues in this case. So on the disposal, what is the entry which company B did? So what company B did in this particular case is it made the entry bank gets a debit, which is the sale proceeds. NCI gets a credit. So this is 1,000 is the net assets. 20% of the net assets would now belong to the NCI. Since the company C has got a total 1,000 of net assets, 20% makes it 200. And on the disposal, 100 is the credit, which is taken to equity directly in terms of SOKI. So in the first part of the question, he is addressing you that particular issue. So let's go back. So if I read the inputs again in the first para, it says B recognized a net assets of C 1,000. B sold 20% interest to a third party for 300, recognized this transaction as equity in accordance with Ind AS 110, resulting in a credit in B's equity, that is 100. Now, if the equity of B increases by 100, that means the net assets of B increases by 100. And if there is a change in the net assets of B, you can well imagine that this led to, you can say, increase in the net assets. So correspondingly, A as an investor would put investment debit. But what is the corresponding credit? When accounting, he should give a credit to equity. Now, he's also given you some financial statements extracts, rather complete. The financial statements of A and B is given before and after the transaction. If you look at the consolidated financial statements of A, there is an equity of 200 and there is an investment in B that's 200. That's it. If you look at the consolidated balance sheet of B, there is an equity of 1,000 and the assets of C, there is 1,000. Now, if you look at the transactions after the transaction, the consolidated financials of B, you can see the changes are incorporating the entry which we have done. Since the equity got a credit of 100, it becomes 1,100. The presence of NCI enters the balance sheet at 200, and you made a sale of the investment, so cash increases by 300. So that entry which we did has been incorporated in the console. Now we can very clearly see that the equity of B from 1000 becomes 1100, and therefore the increase in the equity is increase in the net assets. So what is the entry which A will do? That's the focus of the question. It says, although A did not participate in the transaction, entities A share in the net assets of B increased as a result of a 20% interest in C. Effectively, A has got now a net assets which is 20% of the new equity, 1100, and therefore there is an increase of 20. Now the input is, it's a 6-marker examination questions. How is an equity transaction that is recognized in the financial statements of B reflected in the consolidated financials of A that uses an equity method to account for investment in B? So I think as we read, we have almost solved the question as well. So now in this particular case, we can clearly give the inputs. If you look at the entries which A will pass using the equity method of accounting, so we can say the change in the net assets of C, the changes in net assets of B would mean A needs to debit the investment. So we will put the entry investment gets a debit, mirror accounting equity gets a credit. So whatever is the increase, that increases to the extent of 100. The increase is 100 and my stake in that is 20%, that's 20. So I think what you need to elaborate to the examiner is the step number 2 in terms of equity method, telling him that there are 2 aspects of the equity method of accounting. One is tracking the change in the net assets, and the second is the mirror accounting. Justify the concept of the mirror accounting, typically explaining the credit to the equity in this case. I think it's a wonderful question because this question tells us the insights in terms of the mirror accounting. Wonderful aspect of mirror accounting in this case. Right, so this is another input. So Indus 28 on a standalone basis is mainly the concept of equity method. I'm not getting into the aspect of understanding the quick revisions of how the significant influence is assessed, because significant influence generally is present when you get 20 or more than 20% stake in a company. And there are other parameters also, like the representation of the investors on the board of directors, material transactions between the investor and the investee, etc. So those parameters you would remember, that is the subjective assessment parameters, because you can get a significant influence even if it is less than 20. You may not get a significant influence even if it is more than 20. So that is one aspect, assessment, and this is the core accounting part. Now, what I need to do further, I'm now interested in doing those adjustments from a larger perspective. Though there's one more area which is given in the standard, that is the concept of a loss-making associate. And if you've got some long-term interest, or rather let's call it as other long-term interest in the associate, there is an appendix to Indus 28 which talks of that. We'll be coming to that illustration also very soon. But I think prior to that, I want to do a little more inputs on the balance sheet and in terms of P&L, considering the associate as well. So let's talk of a larger question, considering a subsidiary, considering an associate put together. Now I'm looking at a situation where you are given the balance sheet of the parent, a balance sheet of the subsidiary, and the balance sheet of an associate, and I'm required to apply Indus 110 and Indus 28 simultaneously in this case. The idea of doing this kind of question is to give you more grip in terms of adjustments which you could confront in terms of subsidiary as well as in terms of associate. So I think let's have a look on one question on the balance sheet, one question on the P&L before we come to the other long-term interest elements of 28. So I'm sharing another question to you on the screen. So let's have a look at this particular question. You can maybe take a snapshot of this one as well. Now we are given the financial statements of three companies. One is B, one is H, and one is S. So B is the parent, H is the subsidiary, and S is the associate company. So we're given the balance sheets of all these companies, and then comes the additional information. It says on 1st of July X7, B purchased 45,000 shares in H for 1 lakh. And at that date, the retained earnings is 30,000 and no other components of equity. The highest net assets had a fair value of 1 lakh 20 and the fair value of NCI is 55. It is a good policy to calculate the NCI at the acquisition date at a fair value. Then he says the excess of the fair value of the net assets over the carrying amount relates to a PPE. The PPE has got a remaining life of 5 years at the acquisition date. Goodwill has been subject to impairment and it is determined to be 7,000. So all this information relates to the subsidiary. Typically, we are given the information on the fair value change and we're given the information on the goodwill impairment. And you know, the fair value adjustments would mean impact in terms of step number 2A and in terms of step number, you can say the fair value step number 7. In terms of goodwill impairment, since the NCI is at a fair value, so this will impact my step number 4, 5, and 6. My goodwill, my NCI, and the parent share. Then he says on July X7, B purchased 10,500 shares in Street. That makes it an associate. We'll see the percentages. And on that date, the retained earnings are given and there is no other components of equity. Then he says during the year, B sold goods to H. And that is 10,000 at a margin of 50%. By the reporting date, H sold 80% of the goods. So 20% is still unsold. And if 20% is unsold, we need to take care of the stock reserve. By the way, it's downstream in nature. Then he says, included in the receivables of B and the liabilities of H are also intercompany group balances of 5,000. Then he says on the 5th of July, B received a notification that an employee was claiming damages against as a result of workplace accident that took place on 30th April X8. So there has been a claim by an employee against the company for an accident which took place on before the balance sheet date on 30th April. It says lawyers have advised that there is a 60% chance that you will lose the case and they will be required to pay damages, which means considering the aspect of Ind AS 37, the company should have made provisions for the same, because the probability of losing the case is more. Since it is probable, it becomes a present obligation. And therefore, the damages are 30,000. We are required to make a statement of consolidated financial position on 30 June. So this is a question which contains both a subsidiary and an associate. I'm being a little more futuristic in nature. And I'm just trying to, take you to a question which is a blend of a subsidiary and an associate put together. The complications, adjustments are not complicated, but as I said, Ind AS 28 could be tested at two different levels. One is it could be tested on the levels of just a standalone question, the two steps which we did, or it could be a larger question where you get a balance sheet, subsidy, and associate put together. Now, trust me, in this particular case, it's like, two subsidiary. So whatever you need to do in the 7-step model which I gave you, you are just going to do this twice for every company. So in step 1, you get the acquisition date and the percentage for both. You do the analysis in step number 2A for both. You get the net assets for both the company. You get the PC for both the companies. But of course, you get the NCI for the subsidiary only. And the most important element is you need to add another step to calculate the investment in the associate. So we're going to add a step number 5A to calculate the investment in the associate. Rest, everything remains the same. Finally, in the consolidated balance sheet, what you need to do, you need to consolidate the subsidiary line to line, asset, liabilities, aggregation. But in terms of associate, it would be just a one-line consolidation. Only the investments will appear in the balance sheet. But you can also notice one more inputs in the question, that there has been an omission. And I told you, once there is an omission, it makes sense to make an extract balance sheet in that case. So let's begin the journey. This is on a consolidated balance sheet. And the focus in this case is a subsidiary as well as an associate. So this is a consolidated balance sheet where we are looking at Indus 110 and Indus 28 blended together. Okay, so first what I need to do, I think I need to take you back on the agenda and we will look at the last para in the question. So the balance sheet is on 30th June, but it says on 5th of July, which is post balance sheet date. Reminds me of Indus 10. It says the company received a notification that employee was claiming damages as a result of workplace accident. The accident took place before the balance sheet date. The condition is present. Lawyers are now telling me that there is a 60% chance of losing the case. So what do we need to do? Create a liability in the books and at the same time reduce the retained earnings in the balance sheet. So what I'm going to do, I'll just go back. If you look at the retained earnings of B, it is appearing at 2 lakh. So what we'll do, we'll just make an extract balance sheet in this case. So for this transaction, let's make the extract balance sheet of the company B, just indicating the changes on the balance sheet. The changes would appear on the equity and liability side only, because once you take care of this provision for damages, you need to take the reduction in the retained earnings. So as a part of the equity section, in the retained earnings, the company has got a retained earnings of 2 lakh. We reduce that 30,000. So this becomes 170. And I believe that this provision for damages is something which is current liability in nature. So I am going to show this as a current liability in the balance sheet of the company. So it has given liabilities in the balance sheet. So I think what I'll do, the liabilities of 50 will stand increased. So I am given the liabilities in the balance sheet is 50, and this we add this provision, the provision which is made, and this becomes a total of 80. So this is the changes because of the provision. So the starting point before the 7-step model is making an extract balance sheet in this case. Now, as I said, your process is identify at each stage 2 things. When you go through step number 1, subsidiary, associate, the focus goes on. So let's begin the input in terms of the step number 1. I'm looking at the date of acquisition and I'm looking at the percentage. So we want to look into the subsidiary and the associate both. So let's get the date of acquisition as well as the percentage. For the subsidiary as well as the associate. And I think if you just calculate the inputs, the share capital of the subsidiary is appearing at 75,000. So the parent acquired 45 out of 75. That makes it a 60%. And the date of acquisition is July X7. As far as the associate is concerned, the share capital is 35. So we acquired 10,500 out of 35. So we acquired a 30% stake in the associate. And the date of acquisition is the same. It is July X7. So I think this is getting the acquisition date and the percentages. That is indirectly, you can say the acquisition is at the beginning of the year because it's starting on 30th June X8. As simple and straight. So now let's, I think, begin the inputs in terms of the step number 2A. So here we need the analysis of the other equity. So we need to do 2 analyses at this stage. So I think I'll keep the 2 analysis. one is for the subsidiary, and one is for the associate. As a part of the larger question, you'll have to consider the analysis of both the companies, because at the end of the day, the goodwill is to be computed for both the subsidiary and the associate. So two analysis. So let's pick up the information. This is pre-acquisition. This is post-acquisition. This is the analysis of the subsidiary. This is the analysis of the associate. This is pre-acquisition, and this is post-acquisition in nature. So remember, there were three focus points when you do the analysis. One is that you need to consider the other equity in the balance sheet. Second is the fair value adjustments. And the third is the stock reserve if it is upstream in nature. So let's first of all look at the information in the balance sheet of the subsidiary. Now, the subsidiary has got a retained earnings and other components. So we begin with, first of all, the retained earnings. And let's make a little timeline. So I think if I look at the retained earnings, we are given in the additional information when the parent acquired shares in the subsidiary, the retained earnings at that time, that's at the beginning of the year, was 30. And the retained earnings at the end of the year is supposed to be 50. And my date of acquisition is the beginning of the year itself. So we can say that out of this, 30 becomes free, and the increased 20 becomes post under a separate head, that is retained earnings. Similarly, if you look at the other components of equity, it says on the 1st of July, there was no other components of equity. So if I look at the other components of equity and I make a timeline, so we can see the other components at the end of the year is 5,000 and it was 0 at the beginning. So we can say the entire is post-acquisition. There's nothing pre. But when you take the post-acquisition, just take a separate column for others. As we said earlier during consolidation, that we should segregate the post-acquisition columns so that a line-by-line additions can occur for the RE as well as other components. So I think my first aspect is done. I am taking care of the balance sheet equity. Now we need to consider the fair value adjustments in this case. Back to the additional information, I'll share the screen once again to you to have a look at this. Now back in the additional information, it says that net assets at a fair value 120. Now, if you just go back and look at the balance sheet of the subsidiary, rather just the share capital. So if you look at the equity share capital of the subsidiary, it is appearing at a total of 75,000. And if you look at the pre-acquisition equity, it is appearing at 30. So if you add the equity share capital and the pre-acquisition equity book value, it is 75 plus 30, that makes it 1,05,000. And very clearly it says the net assets had a fair value to the extent of 120. So the increase in 15,000 represents the fair value change. And then it says in the end, the excess of the fair value over the carrying amount is due to property, plant, and equipment, which has got a life of 5 years on the acquisition date. So we've got a fair value adjustments in this case. And I guess if you look at the stock reserve, B sold goods to H. Now, when B sold goods to H, it's a downstream transaction. So I think there's nothing apart from this. So we just, I think, consider the calculation of the fair value adjustments. So we are very clearly given that the net assets on date of acquisition at a fair value is 1,20,000. That's clearly stated in the question. And we can also consider the net assets on the date of acquisition at a book value. This is nothing but a total of the equity share capital, 75, and this pre-acquisition equity, there is 30. So this works out at 1,05,000. So this tells me that this 15,000 increase is, you can say, due to the fair value adjustments of property, plant, equipment. So that is what is very clearly stated. The net assets at the fair value, the net assets at the book value, and you are able to identify that what is the fair value change. This fair value change becomes pre and then the additional depreciation. So let's fit this out here. So we can take the fair value increase, that is pre-acquisition. And due to this, we need to take care of the additional depreciation. The remaining life of the asset is very clearly given that the asset has got a remaining life of 5 years. 5 years would mean an additional depreciation to be reduced. That is 3,000. That becomes an additional depreciation. That's it. So I think out of the 3 focus points, the analysis of other equity done, the fair value adjustments done, there is no stock reserve which is upstream in nature. So let's consider the sum total of this. So this is 45,000 and this is 17,000 and this is 5,000. The analysis of equity of the subsidiary company stands done. Now we'll do this for the associate company, and I think in the associate company we're not given any adjustments effectively, so we just need to take care of the balance sheet inputs. That's it. No stock reserve, no fair value adjustments, nothing is stated. So I guess if I look at the balance sheet of the associate, the only element given is I. There is no other components of equity as well. So we just take care of the RE. So if you look at the RE in the balance sheet, it is appearing at 40,000. And if you look at the balance on the acquisition date, it says clearly in the additional information that when B purchases in S, it says the retained earnings was 25,000 and there is no other components of equity. So this 25,000 becomes pre and this increase of 15,000 becomes post. And I think that's it. Nothing else is stated. So there's no other adjustments for the associate. We get the total of this, that's 25. And we take the total of this, that's 50. So you can see effectively what we're doing, treating this as if there are multiple subsidiaries in the questions. So it's like 2 questions. Every step culminates into 2 inputs. So with this now we go to the step number 2B. So next is the step number 2B. And this is calculating the net assets on the date of acquisitions at a fair value. And in this case, again, you need to organize the data for both the subsidiary as well as the associate. So we'll organize this for both the companies again. So we take this for the subsidiary as well as for the associate, equity share capital, and we got the other equity that is pre-acquisition. Though the subsidiary's net assets on the date of acquisition is already given in the question, but I think still we need to organize that. So the equity share capital was 75,000. And I guess if I take the pre-acquisition, that's 45. So that makes it 120 as is already given in the question. And as far as the associate is concerned, if I go back in the question, the associate company has got an equity share capital of 35. And we can get the pre-acquisition equity is 25. So that makes it a total of 60,000. This is the net assets on the date of acquisition. Right, now with this particular inputs, we go to the step number 3, which is all about organizing the purchase consideration. So we go to the step number 3, that is the purchase consideration. And here again, we need the purchase consideration for the subsidiary as well as for the associate. So let's see the investment in the balance sheet. So here again, we pick this up from the question. The investment in the balance sheet is appearing at 121. So we are given the investment in the balance sheet is 121. So this is the balance sheet figure of investments. And we need to locate, if there could be any outside investments, that could also be another focus point. Now it says in the additional information, B purchases in H the subsidy at 1 lakh. And we're also given that B purchases in the associate at 21. So we can see that there is the sum total is 121. That also gives a conclusion that there is no other investments in the balance sheet. Because if you consider this 121 minus the investment in the subsidiary in the associate, there could have been some outside investments which would have appeared in the consolidated balance sheet. So I think it's important that you should also make a scrutiny very clear to see if there is any other outside investments as well. Okay, so this is step number 3. Then we push on to the next step, and that is step number 4. Step number 4, we need to calculate the NCI. So in terms of the NCI, now NCI will be computed only for the subsidiary, not for the associate. So this will be only with reference to the subsidiary. So we're going to calculate this only for the subsidiary company. So once we take the NCI, it is going to be NCI on the date of acquisition. To this we add the share in post-acquisition profits. The share in post-acquisition profits. And I guess there was some goodwill impairment to be seen as well. So let's see if there is any goodwill impairment to be taken as well. I don't think so, that I am given any goodwill impairment. No, we are. 7,000 is the goodwill impairment. So NCI was at a fair value. So minus the goodwill impairment as well. So the goodwill impairment is 7,000. 40% of this belongs to the NCI. That's 2,800. The NCI on the date of acquisition is again clearly stated in the question. I am given the NCI at a fair value is supposed to be 55,000. And if I consider the share in the post-acquisition profits, we go back to the analysis. So for the subsidiary, we are known the profits 17,000. So out of this 17,000, 40% belongs to the NCI. That works out, I guess, at 6,800. So this gives me the status of the NCI. 55 plus 68 minus 2,800, that works out at 59,000. Great. So step number 4 is done. This calculation was only for the parent, for the subsidiary, because associate there is no NCI. Then we go to the step number 5, which is on the calculation of goodwill, or you can say the bargain purchase gain. Here again, we need to make 2 separate calculations for the subsidiary and associate. But the way the goodwill is calculated for a subsidiary and an associate is different, because for the subsidiary, you take PC plus NCI, compare it with the net assets. But for the associate company, you compare the PC versus the share in the net assets. So slightly different calculations for the subsidiary and the associate. So we take the PC plus the NCI, compare this with the net assets to get the goodwill, and then there is impairment. Then there is impairment of goodwill to get the figures in this case. And this is going to be simply the purchase consideration versus the share in the net assets of the company. So the technique gets slightly different when you calculate the goodwill in these cases. Now, PC we have already organized. I guess the PC is supposed to be 1,21,000. So this is going to be 1 lakh, and this is 21. The NCI on the acquisition date is already there with us. It is 55. And if you look at the net assets, that's 1,20,000. And here we share in the net assets. Out of 60,000, 35% belongs to the associate. So here also we have taken the net assets is 60, and out of the 60, we have taken 35% stake. No, it was 35 or 30%, I think. 30%. The stake is supposed to be 30%. Okay, so let's get the calculation of goodwill or the bargain purchase gain. So 155 minus 120, that's 35. Impairment of goodwill is 7,000, so this becomes 28. Because in this particular case, when you get the revised value of goodwill, you need to reduce the entire goodwill impairment. And this is 18, so we get a goodwill to the extent of 3,000. So both the cases, we are getting a goodwill, but the difference is that this 28 is a part of the outer column calculations, but that 3,000 is supposed to be a part of the inner column disclosures, which is done. Okay, so step number 4 and 5 is done. Now comes the next step. And the next step is crucial, which is going to be an entry in terms of associate. So when you see the associate, you also need the investment as per the equity method. So if you get a larger question, you need to add a step number 5A. So in this particular case, we add the step number 5A, which is calculating the investment in the associate as per equity method of consolidation. Because this is what we need when we are going to make a consolidated balance sheet. So this add-on step is required because equity method means only one line consolidation. So take the investment as a base. I guess if I take the investment, it was 21. And what you need to do is, what you did in that two-step model, exactly what you need to do out here. The step number 2 of the two-step model is the step number 5A out here. So if you technically ask me what is the step number 5A, I would say the step number 5A, it is nothing, but you can say the step number 2 of the two-step model which I gave you. So the two-step model which I give you, so this is nothing but it is exactly the step number 5A. So what you do in terms of the post-acquisition changes in step 2 out of the two-step model, this is the step number 5A. So the associate earned a profits, the net asset goes up. So you need to take the changes in the track. So we add the share in post-acquisition profits. We take the share in the post-acquisition profits in this case. The associate company in the analysis has earned a profit of 15,000. So we take 15,000 into 30%. That works out at 4,500. That's it. So this becomes 25,500. That is the net assets. That is the investment appearing in the consolidated balance sheet in this case. Okay. Now we come back to the step number 6. Now, in terms of step number 6, whatever you were doing for the subsidiary, you need to repeat this for the associate as well. So when you consider the share in the post-acquisition profits, you will take the post-acquisition profits of the subsidiary as well as associate. So I think this time it's like, two subsidiaries. The one is a subsidiary, one is an associate. So let's consider step number 6. So in terms of the step number 6, we want to make the consolidated balance sheet other equity. So let's consider first of all the profits of the parent company as a base. And I think if you look at the parent company, there are 2 lakhs, but you need as 170. So let's take a separate column for RE. The retained earnings is 170. and then there is other components of equity, and that's, I think, 10,000. So the only thing we need to be careful on is the extract balance sheet in this case. So I think worth making a mention that this information is picked up from the extract balance sheet, because when we started off with the question, we made the changes in the extract. Now let's consider the share in the post-acquisition profits. So we add the share in post-acquisition profits. We need in subsidiary, we need in associate. So we need in the subsidiary and the associate. Associate is already given to me. It's 4,500. So that information is very clearly given. Subsidiary, we need to go, the profits I think was 17,000. And 60% belongs to the parent. Yes, the post-acquisition was 17, and this is 5, 17 and 5. So this is 17, and this is 5 into 60%. So there are two elements in this case. The post-acquisition RE is 17 into share, and the post-acquisition other components. So this works out at 17 into 60%, 10,200. And this works out at 3,000. So this is the share in the post-acquisition. Then we need to take care of the goodwill impairment. And there is a stock reserve which is downstream in nature. So there are two more adjustments to go. So we have got the goodwill impairment, the parent share. Goodwill impairment was 7,000 into 60%, that's 4,200, reduces from the RE. And then there is a stock reserve as well, which is downstream in nature. So let's take care of that as well. So we are given in the additional information that B sold goods to H. It says 10,000 at a margin of 50%. But 80% goods have been sold. So 20% goods are unsold. So out of 10,000, 20% is unsold. That makes it 2,000. And the profit margin is 50%. That means on 2,000, a 50% margin would mean 1,000. So we reduce that 1,000. And I think that's it. So post-acquisition done, goodwill impairment, stock reserves done. I guess we get the consolidated RE and other components. So 170 plus 10,200 plus 45 minus this 179,500. I guess this works out at 13,000. Well, the step number 6 stands done. So we have taken care of all the 6 steps. Now the consolidated balance sheet, which is going to be subsidiary line to line, associate one line. So we need to be very careful on the consolidation process. So let's go to the step number 7. So let's go to the step number 7, where we want to make the consolidated balance sheet. So we are going to consider a column for the parent and subsidiary, not associate, and a column for adjustments and total, because we're going to aggregate the parent and the subsidiary. Associate is not aggregated. That's simply the investment in the balance sheet. So let's begin with the asset side of the balance sheet. This is the parent, subsidiary, adjustments, and the total. So let's now take the data from the balance sheet and pick this line to line. So first we have on the asset side of the balance sheet, there is a PPE, which is 1 lakh for the parent, and it is 80,000 for the subsidiary. And there was a fair value adjustments of 15,000. There was an additional depreciation of 3. So we need to take care of that. So this is 180 plus 15 minus 3, 192. Investments will not appear in the balance sheet, but we've got investments in the associate, and this is including a goodwill disclosed in the inner column. Goodwill is 3, so we disclose that goodwill of 3 in the inner column, and I think the investment in step 5A, 25,500. And then there is a goodwill. Goodwill for the subsidiary is 28,000. Associate is a part of the inner column. Then I am given inventories. And inventories, we are given it's 22 and 30. And there is a stock reserve, which is 1,000. So that makes it 51. Then there is receivables. That's to the tune of 70 and 10. And I think there is some intercompany owings also. So I am given the intercompany owings. Receivables is 5,000. So 5,000 intercompany owings gets eliminated. That makes it 75. Then there is cash and cash equivalents. And that's 47 and 25. That makes it, I guess, 72. And I think that's it on the asset side of the balance sheet. So let's see the total of the balance sheet. 192, 25, 500. I think it's 443, 500 is the total of the balance sheet. 443, 500. Okay, so now we can proceed to the liability side of the balance sheet as well. Same formatting continues. So this is particulars, then the parent and the subsidiary and the adjustments and the total. So this is the equity and liabilities, parent, subsidiary, adjustments, and the total. Okay, so let's proceed with the equity and the liability section. So on the equity, we've got the equity share capital. Then we've got the other equity comprising of the retained earnings, the other components, and least we forget the NCI. Equity share capital will be for the parent company, which is 1 lakh. And this can be taken from the step number 6. So from the step 6, 179,500 and 13,000. 179,500, it is 13,000. And as far as NCI goes, the NCI is appearing at 59,000. So this is 59. And I guess the only element is the liabilities. And this is again going to be from the extract balance sheet. Just to remind you, we're going to pick this from the extract balance sheet. That was, I guess, 80,000. And this is 15. And there is an intercompany owings of 5. I guess that's all in the additional information. I think so. Let's see if the balance sheet agrees on this. So this is going to be 90. So let's see the sum total of the liability side. 179,500. 441,500. Difference of 2,000, I guess. Where did we miss that 2,000, I think? Let me just connect the dots. So let me just, I think, verify if there is any calculation error in this particular case. I think we got the equity share capital is correct. Everything is fine. NCI, I think, is 61. I guess NCI, we done some small little error, I think. So let me just check the NCI. So as far as the NCI is concerned, the share in post acquisition. Oh, we missed out that 5,000 because I think I missed out that 5,000 which was there in other components. So we need to add that as well. So slightly make a change on the NCI because the post was retained earnings and other components. That makes it 8,800. So that is 61. So that was the error, I guess, rectified. So the NCI becomes 61. And that takes care of my balance sheet. So 1 lakh plus 179, 13, 61, 90. This is 443,500 is the total of the balance sheet. Yes. So that was quite a comprehensive question indeed, looking at all the inputs in terms of the associate subsidiary consolidated balance sheet. Now, what we're going to do next, not appear with an associate because that might also take time. So what I'm going to do, I have that next agenda, which is that associate company question, which I think I definitely want to do. That is the other long-term interest of the investor in the associate of the company, which makes it a very good question indeed. So I think that is one question we certainly want to do. But I think let's first take a break, then we'll do that particular wonderful questions. Then we'll just take a quick recaps in terms of Index 111 as well. Right, friends. So I think we'll take a break at this stage and see you in 10, 12 minutes time. Enjoy your break. Thank you. relaxation of mind. So let's, I think, take the journey forward. So we are focusing on Index 28, and we've done two categories of questions on Index 28. One is on a standalone basis where you apply a two-step model, and the other one is a consolidated level where you've got an associate and a subsidiary, and you're required to make a consolidated balance sheet. Now, there is one special issue which is there in the appendix to the standard, and that I think is one question which we must definitely practice, because I think not doing that question is not going to be a very interesting affair. So I think we'll do that particular question, which is talks about the other long-term interest of the investor in the associate company. How does the other long-term interest impact the carrying value of the investment as per the equity method? That's what we'll see. So let me share the question to you on the screen, and let's have a look at that. So this is the question number 20 on the screen, which is pertaining to the other long-term interest which the investor has in the associate company. So let's, I think, first read the inputs in this particular case. It says an entity has the following three types of interest in an associate. They've got equity shares, which is 25%, and which equity method of accounting is applied. Then they've got preference shares, which is non-cumulative, that forms part of the net investment in the associate, and they are measured at a fair value as per Index 109. Then there is a long-term loan, which is carrying an interest at the rate of 10% per annum. The interest income is received at the end of the year, and the long-term loan is accounted at amortized cost as per Index 109. This loan also forms a part of the net investment in the associate. So when we're looking at those other long-term interests, just to take a recap, we're looking at all those investments which are, as good as, you can say, a permanent funding. And that is the reason we call them as net investments in the associate. Then he says at the start of the year, the carrying value of each of the above interest is given. So this is there in the study material as well. So we're given the carrying value is equity shares, preference shares, and the long-term loans. And then it says the following table summarizes the changes in the fair value of the preference shares as per Index 109, impairment loss on the long-term loans as per Index 109, and the entity share in the profit or loss of the associate for year 1 to 5. So we're given the fair value changes for the preference share because it is taken at a fair value. And we are given the impairment losses for the long-term loan because it is AC. And then there is a profit or loss share of the investor in the associate company. Throughout year 1 to 5, there has been no objective evidence of impairment in the net investment of the associate. The entity does not have any legal or constructive obligation to share the losses of the associate beyond its interest in the associate. It says, based on the above, determine the closing balance of each of the above interest at the end of the year. Now, I think I'd just like to, first give you an insight just to recall the larger input. This appendix, which is there in Index 28, gets triggered when two parameters are met. Number one, the associate is a loss-making company. And number two, the investor has got other long-term interest in the associate. So unless both the parameters are met, then this appendix cannot get triggered. Because if the associate is a profitable company, then the role of other long-term interest does not come into play. So the moment you see that they've got other long-term interest and the moment you see there is a loss in the associate, put together, the appendix gets triggered. Now let's see, year by year, we've got 5 years to go in this particular case. So let's have the input. So this is question number 20. So the best way of handling this kind of a question is we make an interesting chart. And when you make the interesting chart, first what you need to do, you need to consider the accounting of the relevant standard. So on this other long-term interest, you would apply Index 109. After applying Index 109, then it's time to apply Index 28. So let's do a simple little chart. Let's begin with year number 1. So what we'll do in this particular case, we've got three categories of investments. So let's take a column for these three categories. Let's get their book values. And let's see the application of Index 109. So we can get the revised values. And then let's see the application of Index 28. So we will first of all consider the inputs. Let's take the category of investment. Let's take the book values. Let's see the application of Index 109 to get the revised values. And then we see the application of Index 28. And we can get the revised book values again. So this will be the best way, to do this particular question. Consider the existing book value, apply 109, get the values, apply 28, and get the book values. So let's, I think, pick up the data. So I am first considering that there are three investments, equity shares. Then I am given preference shares. And then I am given long-term loans. So we put them three categories of investments and we take the book value of these investments. That is 10 lakh, that is 5 lakhs, and that is 3 lakh. So this is the book value of the investments when you acquired at the start of the year. Now, the first thing what we need to do is apply the concept of Index 109. So on this equity shares, we are not given any information, so nothing is to be done because this is equity method. So no application of 109 to this. We just go on to the preference share. Now, as per the instructions in year one, there has been a fair value decline of 50,000. So a decline of 50,000. And we are also given for the long-term loan that there is an impairment of 50. So we take care of the fair value decline and the impairment loss for these two investments as per 109. So this becomes 10 lakh, this becomes 4.5, and this becomes 2.5. So this is the information which stands organized after the application of 109. So this is the application of 109. Now we need to see the application of Index 28 as well. So let's now begin with Index 28. Now in this particular case, if you notice, in year one, the investor has got a share of 16 lakh losses. But the problem is that 16 lakh losses cannot be allocated completely to the equity investment. So what do? Out of that 16 lakhs loss of share, we will allocate 10 lakhs to the equity investment. And now what we need to do, pass on this loss to the preference and then pass on the loss to the debt. Because when the company liquidates, the money goes to the long-term loans, then goes to the preference, and then goes to the equity. The distribution is loan, preference, equity. So losses will be equity, preference, loan. I put it again. That's what you need to keep in mind. That when you distribute the money on a liquidation, it is loan, preference share, equity share. So losses will be equity share, preference, and debenture. So in this particular case, the loss of 4.5 lakhs will be allocated towards the next category. And out of this, the remaining 1.5 lakhs allocated to the long-term loan. So we decided the sequence in which that loss of 16 lakhs is to be allocated to each of these investments. So 10 lakh goes here, then 4.5 goes here. So 14.5 is gone. The remaining 1.5 comes out here. Now let's see the revised value. This becomes 0, this becomes 0, and this becomes 1 lakh. So this is the revised values after the end of the first year based on the application of 109. So I would say step 1, 109, step 2, Index 28, and then there is a step number 3, which is not visible in this year, but we'll see this in the next year. Same chart to be prepared for the second year. So we'll make a similar chart for the second year, in this case, same formatting. So we take the book values, 109, revised values, 28, revised value. So this is the year number 2. So we take care of the category of investments, equity shares, preference shares, long-term loans. And from the previous year, we'll pick up the values. So whatever values were there in year number 1, at the end, those values will become the base for the year number 2. So let's pick up the information. I think this was nil, and 1 lakh. So this was nil, this is nil, and this is 1 lakh. So this is the book value. This is index 109. This gives you the revised book values. Then this is application of index 28. And then this is again the revised book values. So this is 109 and this is index 28. Step by step, you apply the process. Let's go to the next year. Now, in the next year, we can see that in the second year, the share in losses is appearing to the extent of 2 lakh. Now, since the share in loss is appearing to the extent of 2 lakhs, now the problem is that in this particular case, the long-term loan is appearing only to the extent of 1 lakh. Since it is appearing only to the extent of 1 lakh, now there is a problem in this particular case, how to allocate the loss. So first, I think we need to do one thing. We need to take care of index 109. So there is a decrease in the fair value to the extent of 50. And for the long-term loans, there is no impairment. Now, what we need to be careful now at this stage is watch this comparison. Because of index 28, we could not allocate this loss of 50 because if we would have not applied index 28, this fair value changes would have been captured. But because of index 28, this loss cannot be absorbed. So what we need to do, last year we allocated a loss of 4,50,000. So we will have to reduce the allocation of loss in the previous year, which means the allocation of losses of 4.5 lakhs as per index 28 needs a reversal to the extent of 50,000. In order to allocate the loss of this 50,000, there is a need to go in for a reversal of the previous loss. So what we do in this particular case, we make a mention that we need to go in for a reversal of last year loss equal to 50,000. So which means there is a loss of 50,000 related to the year number 1, which stands reversed. Only because these fair value losses can be captured, we are reversing. So instead of 4.5 lakhs in the previous year, we are considering that you allocated 4 lakhs. So this 50, the value indirectly becomes 50. So 50 minus 50, the revised value is 0. And in this case, it remains at 1 lakh. And in this case, it remains at nil. So in order to absorb the fair value change, in order to absorb the impairment loss, the reversal of the previous losses will be taken care. So now, in the current year, that is in the second year, the losses are to the extent of 2 lakh, but you need to absorb basically 2 lakh 50. 50,000 losses of the last year and another 2 lakh losses of the current year, 2.5 lakh is to be absorbed. But we can't absorb 2.5 lakhs because this is already 0, this is already 0. So the maximum loss which can be allocated is 1 lakh. So since we know that the losses of 50 for the previous year, the loss of 2 lakh for the current year makes it 2.5, out of which 1 lakh allocated in this year. So we need to get what is the carry forward loss. The carry forward loss is 1.5 lakh. This is like step 3. Step 1 is 109, step 2 is index 28, and step 3 is getting what is the losses which cannot be absorbed in this year, which is going to be carried forward and merged with the losses in the next year. So with this inputs now, we can get the value. So this is nil, nil, and nil. So that makes it the status as far as the year number 2 is concerned. Now let's go to the third year. Similar chart to be prepared in the year number 3 as well. And as you make this chart, you should also make a pinpoint that there is a carry forward losses relating to the previous year. So this is year number 3. This is the book value, the application of Index 109. We get the revised book value, the application of Index 28, and the revised book values. And I think least we forget what you should make a mention is the carry forward. There is a carry forward loss which is to the extent of 1.5 lakhs. So this is immediately you should notice that whatever is the losses related to the previous year which could not be absorbed has been carried forward to be included in third year loss. There is no loss in the third year, so we stand safe. Now let's go to the third year. So let's take the values out here. So we've got equity shares, we've got preference shares, and we've got a long-term loan. All these values in the previous year was 0. Now here again we go back to the third year to identify what is the fair value changes and what is the impairment loss. This time in terms of the preference share, there is a fair value gain to the extent of 1 lakh. So there is a fair value gain in terms of the preference shares, that is 1 lakh. And there is a reversal of an impairment loss on account of long-term loan. That's the best part. So there is a fair value change and there is a reversal. In this case, nothing. So this becomes 0, this becomes 1 lakh, and this becomes 50. Now it's time to consider the losses which are carried forward and the current year share of loss. In the current year, in third year, there is no loss. So the only losses to be allocated is the carry forward, because current year there is no loss. So once you get that 1.5 lakh carry forward loss, 1 lakh adjusted from here, and 50,000, that is 0.5 lakh adjusted from here. So that 1.5 lakh carry forward losses adjusted against the preference and then against the long-term loan. So we get the revised value. It is nil, and it is nil. That makes a complete sense. So the crucial step is always to see that if there is an interference of Index 109, the losses of the previous year needs to be reversed. And then you need to see that if there is any carry forward losses in a given year, which can be merged with the losses of the current year and then allocate. Now let's go to the year number 4. So let's go to the year number 4. So we've got 5 years to make. So the formatting again remains the same. Book value 109, revised value 28, 109. So we take the category of investments, equity shares, preference shares, as well as long-term loans. And I think it's worth, making a mention out here as well, that when you are considering, so when you're considering the information out here, we can say that there is no carry forward losses in this case. Because previous year when we applied the funda, then there was no carry forward losses in that case. So let's take the book values, the application of Index 109, we get the application of Index 28, again the revised book values. So as usual, we are applying 109 and 28 step by step. Now, we need to pick up the figures from the previous year. I think it was all supposed to be 0, I guess. Yes. So this is all supposed to be nil. This is all 0. Then we go to the fourth year. Now, in the fourth year, we are given that there is a fair value gain to the extent of 50, and there's no impairment or reversal in the third year, in the fourth year for this investment. So we get the values. This is nil, this is 50,000, and this is nil. Now, in the fourth year, the company's, the investor share in the profits is 10 lakh. Now it is profit to be distributed. Now, when you distribute the profits, it goes to the long-term loan, then goes to the preference, and then goes to the equity. Till the long-term loan gets back the losses allocated to him, I'll not move to the preference. Till the preference has been allocated the losses given to him, will not move to the equity. So it's time to identify how much losses were given to the long-term loan, how much losses were given to the preference in all these previous 3 years. Time to revisit back on the charts. So let's take the calculations in terms of year number 1. In terms of year number 1, you allocated a loss of 1.5. First year, you allocated a loss of 1.5. Then second year, you allocated a loss of 1. Makes it 2.5. Makes it 2.5. And then in the third year, you allocated a loss of 0.5. That makes it 3 lakh. So total losses allocated till date is 3 lakh. This is the losses allocated till date. This is the losses which are allocated till date. So we will basically reverse them, give them a gain to the extent of losses allocated till date. Similarly, let's go to the preference. So in terms of year number 1, if I look at the preference, the allocation was 4.5. Then there was a reversal of 50 that makes it 4 lakh. Then 4 plus 1 that makes it 5 lakh. The losses allocated to date is supposed to be 5 lakh. So you need to revisit all the previous years and see what is the losses allocated till date. He was given a loss of 3 till date. He was given a loss of 5 lakh till date. So once you look at the share in the profits, it is 10 lakh. So 8 is gone here. So he gets the remaining 2 lakhs at this stage. So with this, we can get the revised values. So this comes to 2 lakh. And this comes to 5.5 lakhs. And this comes to 3 lakh. This is the revised values post the allocations of the gains as per Index 28. Now, there is no carry forward losses which are there. All the losses stands absorbed. Now we go to the year number 5. So we go to the last year, that is year number 5. Same chart all over again. So year number 5, we make the same chart, book value, 109, revised value. So this is the category of investment. We consider the book value, application of 109, revised values, application of Index 28, revised book values, stage by stage, 109, 28, and so on. So the task can be easy if you go systematic, step by step by step. Okay, so first we pick up the values of the investment previously. So we take care of the equity shares, then the preference shares, and then the long-term loans. And I guess if I come back, it is 2, 5.5. It is 2, it is 5.5, and it is 3 lakhs. Let's look at 109 to begin with. In the year number 5, there has been a fair value change in terms of preference, that is 30. There's nothing in terms of long-term loan. So let's get the revised value. This becomes 2. This becomes 5.8. and this becomes 3. And then we are given that there is a share in the profits. The investor share in the associate is 10 lakh. So we've got a profit share which is to the extent of 10 lakhs to be distributed. Now here, what you need to be careful on, is there any losses which could not be given back to the preference and the long-term loan? If there is any losses which could not be given back to them, you will first allocate the losses to the preference and long-term loan. In the previous year itself, we were able to manage the reversal of the losses of the preference and the long-term loan. So they don't need to be given anything. So they get nothing. So the entire gain that goes to the equity shares in this case. So the revised values in this case is 12 lakh, it is 5.8 lakhs, and this is 3 lakh. So this is the value of the investment which stands for all these 3 categories. That was a good question indeed. So that takes care of the elements in terms of Index 28. Technically, if you just try to revisit in your mind, then one of the core concepts in terms of Index 28, significant influence assessment, which I didn't touch much because I think that's fairly simple and straight. Then the application of the equity method on a standalone basis, the 2-step model which I gave you. Then the application of the equity method in a larger question with a subsidiary company. And we also looked into the, you can say, accounting for other long-term interest in the associate, especially when the associate is a loss-making company. Now, I think let's come back on the agenda and let's do a little revisit on Ind AS 111, joint arrangements. So I think let's begin the journey, the last area on the consolidation. So we're going to make a next mind map. I think this is my mind map number 3, which is on Ind AS 111, that is called joint arrangements. So this is on the area of joint arrangements. That is Ind AS 111. So let's make a mind map on this relevant Ind AS as well. Okay, let's connect the dots now. Now, when I look at Ind AS 111, there is joint arrangement. The focus point, what comes to the mind is 3 blocks again. Assessment, whether it is a joint arrangement, that's 1. Classification of the joint arrangement in terms of JO and the JV. Because the moment you say it is a JV, you switch over to Ind AS 28. The equity method applies for a consolidation for a JV. But if it is a joint operation, you are within Ind AS 111. And the third is the aspect in terms of accounting for a JV and a JA. So you could map your mind in terms of 3 focus area. Is it a JA? What is the category of JA, JV or JO, and the accounting of JV, JO in the separate and in the consolidated financial. So I think I'm going to make 3 sub-mind maps within Ind AS 111. And let's begin with the first one. So the first sub-mind map. So we're looking at that, is it a joint arrangement? The question is that, is it a joint arrangement? Now, for this particular aspect, if you remember in the regular sessions, we had a 3-step model again. And in terms of the 3-step model, we identified number 1, is there a contractual arrangement, CA? And number 2 and number 3, that is there a joint control? In terms of joint control, there are 2 elements. Number 1, that there is a common control, CC, and number 2, is there a unanimous consent, UC? So we understood the element of a 3-step model in this case. So if I connect the inputs in terms of the 3-step model, the first one is there a contractual arrangement We'll look at the first aspect, that is there a contractual arrangement. So that is the focus number one, that there is a contractual arrangement. We call this as CA. Now, when you say there is a contractual arrangement, you would recall that the parties have entered into an agreement where they lay down the rights and obligations of the party. So there is, let's say, a contract between the parties where they are legally bound and the rights and obligations are laid down. The second step is in terms of identifying. The second step is in terms of identifying, that second and the third, I would say combined, is to look at the concept of what we call JC, that is a joint control. The second and third is devoted to the assessment that there is a joint control. And in terms of the joint control, we've got number one, what is called common control. What is called a common control, that is CC. And the other one is what we call a unanimous, that is called a unanimous consent, and that is UC. So put together, it creates a joint control over a company. So when you say that there is a common control, which means on a standalone basis, you do not control, but you with someone, or maybe two or more than two people, jointly control the affairs. Not anybody can take decisions independently. You don't have a control, you can't take decisions independently. But unanimous consent would mean that at the same time, people will also need your consent as well. So for a joint control, there has to be a two-way traffic. That you cannot take decisions alone, CC, and people can't take decisions without you, that is UC. It's like a two-way control factor. So once you prove this, it becomes a case of joint control, and it is a joint arrangement and comes under the purview of a joint arrangement. Next. The second input in the standard is the type of joint arrangement. This is where you get questions, and we'll deal with one of the questions on this area as well. We'll look at the type of a joint arrangement. That is it a JV or is it supposed to be a JO? Now, in this case, when you classify that it is a JV or a JO, you need to consider first of all a very basic question. Was a separate vehicle created? So the first question what you need to put across is that was a separate vehicle created or not? So did the companies create a separate vehicle or not? A and B existing companies enter into an arrangement without an establishment of a separate vehicle? Or A and B, they create a separate vehicle? So the answer is a yes or a no. So in this case, if you say no, we did not create a separate vehicle, it is undoubtedly a joint operation. No further questions asked. If you do not create a separate vehicle, then it is a joint operation. But if you say yes, we created a separate vehicle, then if you remember, I again gave you the concept of a three-step model in this case to identify that is it a JV or is it supposed to be a JO. So let's recall what are the three steps on which you get questions in the exam. So let's see what is the three-step model in this case. So when you say that a separate vehicle is created, we got to apply a step number one, we need to apply a step number two, and a step number three. Now, what is the focus point? When you're looking at the fact that a separate vehicle is created, you need to see the form. What is the nature? What is the form of that separate vehicle? Is it created as a company? Is it created as a firm? Or is it created as a LLP? You need to basically consider the legal form of that vehicle. So your focus in terms of step number one is to look at the legal form. When you say the legal form, you can structure it as a company, you can structure it as an LLP, or you can structure it like a normal partnership firm. Because the first step is to see that the you can say the parties to the venture and you can say the separate vehicle have a separate legal entity concept. The legal form is to check that a separate legal entity concept is there. So when you say it is supposed to be a company or an LLP, then it is called a joint venture. But if it is a firm, it becomes a joint operation. But irrespective, the creation is a company, LLP, a firm, you need to go to the step number two, irrespective. You need to go to the step number two, irrespective. And once you come to the step number two, you need to see, you can say, the contractual terms. You need to see that what are the contractual terms. Now, the contractual terms could be silent or the contractual terms are present. The parties to the arrangement have either entered into contractual terms, so all the terms are completely silent in nature, or they have entered into the terms. If the contractual terms are silent in nature, then it is time to go to the step number three. And if the contractual terms are present, you need to see what are the parties getting. Are the parties getting a share in the net assets and the net profits, or are they getting a share in the assets, liability, income, and expense? So you need to see that what are the contractual terms between the parties, what are they getting? So are the parties in this case, are the parties to the arrangement getting a share in the net assets and the net profit, or are they getting a share in the asset, liability, income, and expense? So in case we say that they are getting a share in the net assets and net profits of the company, then it is supposed to be a JV. And in this particular case, it is a JO. And once the contractual terms are present, there is no need to go to the step number three. The need to go to the step number three is only if the contractual terms are silent in nature. And finally, in terms of the step number three, when you go to the step number three, you need to look at other facts and circumstances. You need to see the other facts and circumstances. What do they indicate? What are the other facts and circumstances? Are they indicating a contradiction? Because if there is a contradiction between the step one and two, if there is a contradiction in terms of step number one and two, then the step two prevails. And if there is a contradiction between the step one and three, because you would bypass step number two if it is silent. So there could be a contradiction in one and two, or there can be contradiction in one and three. So if there is a contradiction in terms of one and three, then we can say the third step will prevail. So in terms of other facts and circumstances, if you recall, the other facts and circumstances would be, for example, if you say that the separate vehicle has got no external sales and it is making the sales to the parties on a cost to cost basis, that indicates a GO. So this is what we saw in terms of other facts and circumstances. So we can say in other facts and circumstances, number one, the separate vehicle has no external sales. The separate vehicle has got no external sales, that's one. And number two, we can say in this particular case, the sales are to ensure break-even point. The sales are there to ensure a break-even point. So if both the factors are met together, that they've got no external sales and this is cost to cost basis, then these factors would indicate that it is a joint operation. I think let's do a case study on this part. This has come once in exams as well. So we'll do a question on this area with you. So I'm taking a question number from the handout, which is question number 15. It's an RTP question, a bigger one, but it's a good one indeed. Let's, I think, have a read on this. So it says identify the type of joint arrangements in each of the following scenario. Now, this is came in RTP in May 22. Now, there are a couple of scenarios, I guess a total of 5 scenarios, I guess. No, more than that, 6 scenarios. So we need to carefully analyze the inputs in terms of each of these scenarios. It says identify the types of arrangements in each of these scenarios. So I am given X and Y manufacturing similar type of mobile phones forms a joint arrangement. It says to manufacture and sell mobile phones. Under the terms of the arrangement, both X and Y use their own assets to manufacture the mobile phones, and both are responsible for liabilities related to the respective manufacturer. The arrangement lays down the distribution of revenues from the sale of mobile phones and expenses incurred. X, however, has exclusive control over marketing and distribution functions and does not require the consent of Y in this respect. No separate entity is created in the arrangement. I think the highlighted point is no separate entity is created. So if you go back to the identification of the joint arrangement, when you do not create a separate vehicle, it outrightly becomes a case of a JO. So the point one is JO. Then he says, continuing with one above, what would be the classification if the joint arrangement of the joint arrangement if X and Y both jointly control all the relevant activities of the joint arrangement, including marketing and distribution function? Well, in the first case, first of all, if you notice that X has got some exclusive control over marketing and distribution function, does this mean that there is no unanimous consent required? I think finance decisions are something which is, the core aspect of taking decision. Marketing and distribution decisions may not require per se a unanimous consent, but I think if the financial decisions are taken by both of them, in those particular cases, I would say indirectly the marketing and distribution decisions are also taken by both the parties. So in the second case, when you say that they are having, a joint control of all the activities, the answer would not change. I think the joint control is there in one, the joint control is there in two, and the arrangement continues to be a JO. Then he says, what would be the classification if under the terms of the arrangement, a separate entity is created to manufacture the mobile phone? I think in that particular case, it is definitely can't be concluded that it is a JO. You need to apply the other parameters to see the legal form, to look at the contractual terms of the parties, and then come to the conclusion that what is the status. So I think in the part number 3, we'll say that we need to evaluate the factors, that is the legal form, the contractual terms, and the other facts and circumstances. Next, number 4. It says, continuing with the 3 above, the joint arrangement is a means of manufacturing mobile phones on a common platform. But the output of the arrangement is purchased by both X and Y 50-50. The joint arrangement cannot sell output to third parties. So one of the conditions met is no external sale. The price of the output sold to X and Y is set by both the parties to the arrangement to cover the production cost and other administrative costs. That ensures that they hand to mouth. That ensures that the company does a break even. So I think it throws lights on the other facts and circumstances that in this particular case, no external party sale and the goods are transferred on a cost to cost basis. I think that would indicate it is definitely JV. Would your answer be different if X and Y sold their respective shares of output to third parties? No, that would not make a difference. There is a clarification given in the standard that once the parties take the output of the third vehicle, the third party, and then even if they make a subsequent sale, that does not preclude of being classified as a JO. Then he says, assume that in the point number 4, the contractual terms modified so that the arrangement is not obliged to sell the output to X and Y, but is able to sell to the third parties, then it'll become a JV. Because if there is an external party sale which is allowed, it becomes a JV. So I think just to connect a few dots, just to make a mention regarding the inputs, I'm just going to add some notes. So in terms of the question number 15, I'm just keeping the question in front of the screen so that you can just correlate the inputs, one-liner answers. So we can say in the first case, there is no separate vehicle. So it would be a joint operation. And in the second situation, when it says that, I would say the answer would remain the same. So I think the answer in this case remains same, because even if the distribution and the marketing activities are not under that exclusive control, I think doesn't make a difference. The third one is that if they create a separate entity, it can be a JV or a JO. It can be a JV or a JO. So we need to evaluate the facts. Then in point number 4, when it says that they have got some no external sales, etc., it becomes a JO. Then in terms of the point number 5, if they are able to sell it to the outsiders, it still remains JO. And I guess in terms of the point number 6, it will become a JO. So I think the particular question, is testing us from all the aspects very carefully. They are testing us in terms of all the 3-step model inputs which I gave you, tested us from all the areas. So 2 aspects are done. Identifying the arrangement is a JA, that's taken care, and identifying the type of the arrangement, JV or JO, is done there. Now comes the third aspect, that is accounting treatment. So which applicable consolidations would apply? So let me make a third sub-mind map, because the first one was on the JA, second was on the type. Now we're looking at the third one, the third sub-mind map. So I'm looking at now the accounting treatment. So let's make a comprehensive chart based on this permutations combination. So something good is coming to my mind at this stage. If you recall, even in the regular sessions, I think we definitely made a certain point, and that was, when you look at the accounting of a JV and a JO, the 2 focus points are, number 1, separate or consolidated financials. Another 2 focus points is that there are 2 types of parties. One is who are parties to joint control, and one is parties who are not a party to the joint control. They're part of the arrangement, but they do not have a joint control. So let's make some permutations, combinations out here. So let's create some combinations out here. So we're looking at the broader picture in terms of 2 areas. Let's divide this into, and let's divide this further out here into. So I am looking at a joint operation. The parties have a joint control, but let's say one party does not have a joint control. Then there is a JV, so the parties have a joint control, or let's say one party is not having a joint control. Because when you enter into an arrangement, just to, I think, give you the dots connected, you would recall, let's say, for example, I just take an example to, revive the concept back. So let's say there are 3 parties, ABC. He's got a 50% stake, he's got a 30% stake, he's got a 20% stake. And in order to take decisions, we need a 75% stake. So we can easily say that A and B together have a joint control, and C is not got a joint control. He is a party to the arrangement, but then A and B can collectively take decisions because their percentage is 80% and we need a 75% to achieve a target. So in this particular case, we can say C is a party to the arrangement, but he is not party to the joint control in this case. So here we're looking at, you can say A and B. And here we are basically looking at the books of C. Here we're looking at A and B, and here we're looking at the books of C. And we've got the inputs in terms of separate financials and in terms of consolidated financial. So looking at the accounting in the books of separate and console in all these permutation combinations, once you get that, the entire insights becomes clear. Okay, so let's, I think, connect the inputs. Now, if you look at the case of a joint operation, Index 111 does not make any difference between these four cases. Whether it is separate, whether it is consolidated, whether it is a party with a joint control or a party without a joint control, we present the assets with a share in assets, liability with a share in liabilities, income with a share in income, and expense. So in this case, all these cases, the answer is same. So when you take the assets, we add the share. When you take the liabilities, we add the share. When you take the incomes or the expense, we add the share. So the accounting treatment in the separate and the consolidated financial statements for this particular Venn diagram remains the same, that in these cases, we need to consider assets share, liability share. Sometimes for the ease of understanding, we do call it as a proportionate share, proportionate consolidation method, though it's not technically a proportionate consolidation method per se. But sometimes for understanding, we call this as a proportionate consolidation as well. Now let's have a look at the input in terms of the other combinations. In the separate financial statements, you would apply Index 27, where you take the investments generally at a cost, though we're given a fair value choice as well. In a consolidated financial statements, it all depends upon, okay, it's a JV, so it is going to be Index 28. You apply the equity method of consolidation. And this is, you can say, the cost or the fair value choice is given in terms of the step. And if you look at the parties without a joint control, if the party is without a joint control, you need to see that is there a significant influence or there is no significant influence as well. Because when you look at a party with a joint control, sorry, not with a joint control, you need to make an assessment that maybe if not a joint control, they've got a significant influence. If you say yes, they will apply Index 27. And if you say no, then it becomes a passive investment and you would carry the investments as per 109, that is financial instrument standard. And similarly, when it comes to the consolidated financials, the sequence will again remain the same. That in this particular case, again, we will say that, okay, they've got a significant influence or there is no significant influence. So if you say that there is a significant influence, then equity method would apply. That is Index 28, because joint venture and associate both are covered in terms of Index 28. And in this case, we can say the consolidation is not applicable, because if it is a passive investor, the consolidations would not trigger. So that was the insight in terms of the mind map number 3, giving us the insights of the accounting treatment. So if you just now connect the dots, in terms of Index 111, I have covered 3 aspects with you. So in my mind map, if I just consolidate the joint arrangements, the 3 focus points is it a joint arrangement? Is it a JV or a JO? And what is the accounting treatment? In terms of joint arrangement, your focus comes on 3 aspects. Contractual arrangement. It is supposed to be a joint control, means a common control with a unanimous consent. So once you prove CA, CC, UC, it becomes a JA. The second inputs which I gave you, that was on the type of the joint arrangement. The focus is very clear that if you do not create a separate vehicle, it is JO. If you create a separate vehicle, then you need to apply again the 3 parameters. The first one is legal form, the form in which organization is created. Then you look at the contractual arrangements. Are the parties trying to override the inputs by contractual arrangements? Are they getting share in the net assets, net profit? Are they getting a share in the assets, liability, income and expense individually? And the third aspect is looking at any other facts and circumstances which could indicate something to the contrary. So if there's a contradiction in step 1 and 2, you listen to 2. If the step 2 is silent, you go to 3. So if there's a contradiction in 1 and 3, then you listen to the step number 3. So the question also comes to the mind, then what is the role of step number 1? The role of step number 1 is only that if the step number 2 is not there, 3 is silent, then the step 1 decides the fate. Otherwise, it can be different in nature. And then further, I came to the step number 3. Then further, we came to the step number 3. The third issue in this particular case is the accounting treatment, where you need to consider separate consolidate financials, and in the separate and consolidate financials, parties with joint arrangements, party which are not having a joint control. What do we do? So now it takes care of all our consolidation standards together. I've done Indus 103, I've done Indus 110, I've done Indus 28, I've done Indus 111, and we've touched upon a bit on the Indus 27 as well. So the journey from my side on the consolidation comes to an end, but I think your journey definitely begins on this case. Now, what you need to do is, once you've done the revision, sit down, do the questions, study material, past examination papers, RTPs and all. You've still got good time to go get the control. Because once the financial instruments and the consolidation is done, you get a grip on almost a good chunk of the paper, because you can really think of questions, papers without financial instruments, without consolidation schedule. Right, friends. So I think that's all from my side on the consolidations aspect to you. So that's all for the day. I'm done with the consolidation. So thank you very much for watching, and all the best. Thank you. Bye-bye, and take care. Thank you. Thank you. Same to you.